Do you guys remember the video I did where I talked about Fed Bullard and what his thoughts were? I posted this video a couple days back, and I talked about how Fed Bullard sees interest rates could be 5 to 7%, and especially closer to 7% or above being the restrictive area. And remember what I said in that video where I said it's going to be very crucial to hear other Fed members come out and see what they have to say and sound similar to what Fed Bullard was saying. Now, Fed Bullard was pretty hawkish. He came out, said these comments, and we saw stocks and bonds sell off. Now, those sell-offs that we saw kind of reversed itself, and we're now in a trading range, especially this week as we have U.S. Thanksgiving coming up, and it's going to be kind of a slow, quiet week. Not saying we can't see any sell-offs or moves. Definitely we can see some, but definitely, there's going to be less liquidity, less volume, less participants as it is holiday in the U.S. and on Thursday, and half day off on Friday, right? So going back to what I was saying, Fed Bullard came out quite hawkish on that day, discussing about his views and the restrictive zone. And guess what? Who came out to speak today? Other Fed members, other FOMC members, like Mester, like Daly. Now, Mester came out, said a couple of the few things about rates, same as what she's been saying for some time, but very interesting that she said that we're not in restrictive area. That's quite interesting because I remember a couple months back, they were talking about that this 4%, this 3 or 4%, around that area would be considered restrictive. But now we're talking about a new area that could be the restrictive zone, and that could be 5, 6, or 7%. And Mester came out and said, we're still not there. We're still thinking of whether we should get to the restrictive zone. Maybe, maybe not. We're definitely slowing down the pace of the rate hikes, but we're not done with rate hikes. We're still going to increase we're going to increase the interest rates. We're going to continue at this, maybe slow down the pace, but continue to push up rates and to continue to bring in pain so inflation can come down, and possibly unemployment, job losses can increase, and hopefully the wages come down a bit, and that will solve inflation. So that was number one thing that I picked up about Mester, not calling this the restrictive area. So what is the restrictive area? It's very vague. I don't know. I'm actually kind of confused. Maybe you can leave a comment below and let me know what you guys think. But it looks like by these subtle comments, they're pushing for rates to go further, higher and higher and higher. And they might be realizing that as they push rates higher, and of course it's going to be data dependent, but as they push rates higher and keep them there higher for longer, they will continue to be at this pace or raise rates so that inflation can come down. And if it doesn't come down, then guess what? They're going higher and higher to that maybe restrictive area that Bullard talked about. Now, here's another one. Daly came out. Fed Daly said that, taking 0.75%, 75 basis point rate hikes off the table is too premature. Right? So we've heard that also from other Fed members as well, that, 75 basis point is not off the table. It's still on the table. And obviously that can change again as we have data in December coming up, like non-farm payrolls. We still have another CPI print to come in. But to me, it's still not over until the Fed is able to bring inflation down to that 2% or below. And how do you get there? Well, you got to create some sort of recession, some sort of crash. That's how I see it, where this is going, some sort of really severe recession to bring inflation lower. Now, since Daly came out and talked about that's too premature, we had another Fed member talk about Bullard sounding hawkish, Mester maybe throwing in a little bit of a hawkish line there. even though she wasn't overly hawkish, it might be setting up the tone for the next FOMC meeting. So it's going to be very interesting to see in the next coming weeks where the data is, where's non-farm payrolls, what's the jobs data looking like, what's the wages looking like, and what's the CPI print looking like as well. Now, oil's been fluctuating up and down. We heard some headlines about possibly OPEC producing more barrels of oil, which brought prices down, and then Saudi Arabia coming out and denying that, which caused oil prices to then move back up and retrace the whole move. Oil still steadily around the area of 70 to 80 bucks per barrel for the WTI crude oil. And you are still seeing, if you look around, I don't know about your area, but for sure in my area, if you look around on shelves in Walmart or your grocery stores, there's still some items that, are not on the shelves, or there's a shortage of them, right? We also have shortages of certain medicines, right? We have shortages of certain goods. If you want to do any renovations in terms of building a cabinet or whatever, try to go to IKEA or what have you, there's still shortages there. Prices are still increasing. Food inflation, grocery inflation, grocery prices, all of these prices are moving higher and higher, or at elevated levels, and it still hasn't come down. So when you're talking about the CPI and inflation report, especially in areas that really matter to us, like for example food, it's still a massive hurdle for a lot of consumers out there. A lot of consumers are feeling the pinch, and they have to slow down. They have to slow down their spending. And especially if they slow down their spending, what is that going to do? It's a trickle effect for corporations out there. That's why you're seeing the layoffs. That's why you're seeing even big tech coming out. Like, for example, the CEO of Amazon, Jeff Bezos, saying that, we could see a very ugly recession come out. Long ago, Elon Musk said the same thing. Now we're seeing Tesla price kind of sell off as we, speak today. Tesla was selling off quite a bit today. And we're seeing the effects of big layoffs, tech layoffs happen, and that yet has to be reported or seen in the economic data, in the jobs data. We have yet to see that or see the true impact, the hard impact, and it's not here yet, although the big tech is doing a lot of layoffs than what people were expecting. And this is just the beginning, right? Maybe it's not a lot. Maybe you guys think it's not. But this is just the beginning for sure. And we could see more of these layoffs come in next year, especially if data and economy starts to deteriorate a lot more. And why? Right? Why is this? Because the Fed has been saying all this year, and I've been posting about this as well, that they want to go ahead and create pain in the economy, cause that unemployment rate to go up so that wages can come down, so that the inflation can come down. And that's how you get it lower according to the central bank. So let's see if it works out. It's very likely that it can, but that's what we expect for 2023. Now, the bond market also is pricing in that we're not probably going to see any rate cuts next year. That's also very interesting. Before we were talking about this pivot, we were talking about, cutting rates. Some people were. That's what pivot means to me. If you're pivoting, you're cutting rates. You're going from raising rates to cutting rates. But it doesn't look like that's going to happen anytime soon, especially if inflation's elevated. Especially if inflation does come down to 5%, it's still not over. The Fed needs to hit its 2% goal, its 2% target. And they can do it if they create this severe recession, right? Or at least we'd like to think they can do it. We'll see when time comes. Now, on top of all of this hawkishness that's coming up from the Fed, We'll have to really watch not only the other Fed members and what they also have to say, but we're already seeing signs of little bit of this hawkishness that could really surprise the equity markets. Right? The equity markets are still in la la land, in my opinion, thinking that this pivot's going to solve it all. I don't think so. I really don't think so. I think there's much more to it, and I believe that we could see rates higher for longer, even if they decide to pause. Like the bond market's pricing in, they could pause for the rest of 2023. And then if something breaks, then sure, you can start getting rate cuts maybe in 2024. But let's see, if something breaks in 2023, then definitely you'll probably get the rate cuts early. The bond market can be wrong as well, right? Just like the stock market. But if we start to see next year the data deteriorate, the jobs number deteriorate, the unemployment rate skyrocket, equities may like that initially, but then there could be some panic selling, panic sell-offs in the equity market that could be short-lived, and then that could trigger inflation to come down and maybe the Fed to step in. But I don't see the Fed stepping in and cutting rates all of a sudden, and we should be all happy about it, that this pivot is coming, especially if inflation's still elevated. So pretty interesting to hear Mester and Daly come out. I'll post a link in the description for you to read the article about Daly, Fed Daly, coming out and saying it's too premature to take 75 basis point off the table. Definitely, we still have CPI next month that could change things, and they could just go for the 50. Things could change very rapidly in the span of 1 to 2 weeks. But we'll see what happens. So I'll leave that link in there for you to read the article. Leave a comment below. Let me know what you guys think. Hit the like button, subscribe button as well, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.